I had this realization this morning that genuinely just annoyed me.
Oh, yeah. What happened?
Well, I was sending a massive file to a colleague over in Tokyo. We're talking high-res photos, heavily formatted text, the works. I hit send, and literally before I could even take a sip of my coffee, he was replying.
Right. Instant delivery.
Yeah, it was free, it was instant, completely flawless. I mean, the internet has basically perfected the movement of information.
It really is the crowning achievement of the digital age. This
Yeah.
completely frictionless communication.
Exactly. But then I tried to pay a freelance designer working in that exact same Tokyo office. And suddenly, the year 2026 just evaporated, and I was back in 1995.
Let me guess, the fees were absurd.
Oh, totally absurd. And the bank told me it would take, 3 to 5 business days. And honestly, for about 48 hours there, neither of us actually knew where the money was.
It just disappears into the void.
Right. It's the old, the check is in the mail era, but just digitized. And it got me thinking, why is moving data instantaneous, but moving value still feels like we're relying on the Pony Express?
Well, that specific frustration is exactly why we are doing this deep dive today.
Because it is a massive problem.
It is. But before we really get into the plumbing of it all, we need to anchor ourselves in the timeline for everyone listening. Because it is February 21st, 2026.
A date that matters immensely because if you've been, blinking for the last 12 months, you might have missed that the entire financial world basically just turned upside down.
It really did. I mean, throughout 2025, we watched what was supposed to be this ultimate death match between the old guard,
Swift.
right, Swift, and the challenger, Ripple. For a decade, the narrative fed to all of us was that one of these systems had to die for the other to live.
A total zero-sum game.
Exactly.
Yep.
But looking at the stack of research we pulled for this deep dive, we've got academic theses, we have legal briefs from the end of 25 market reports. That is not what actually happened.
No, instead we got a massive plot twist. So today, our mission is to unpack whether blockchain is actually killing the legacy banking system, or if, and this is the part that genuinely surprised me, it's actually the thing saving it.
Right, we have to look at the actual cost of trapped cash, the legal battles that finally wrapped up last summer, and of course, the empire striking back.
It is a classic disruption story, just with a very messy, very human resolution. So let's start with the villain of my morning, or at least the reason I paid those ridiculous fees, the legacy system.
SWIFT, the Society for Worldwide Interbank Financial Telecommunication.
Even the name just sounds like it's wearing a polyester suit from the 70s.
It does, but it is the absolute backbone of global finance. It connects over 11,000 institutions. But there is a huge misconception here that we need to clear up immediately for you listening. SWIFT is not a bank.
Right, they don't hold the money.
They don't hold a single cent. It's a messaging service.
So it's basically just a highly secure chat room for banks.
Think of it more like a secure telex system that just never quite evolved into the modern internet era until very recently. It just sends instructions like, please debit account A and credit account B.
Okay, so the problem isn't the message itself.
No, the problem is the route the money actually has to take to follow that message. This is what the industry calls correspondent banking.
Right, and I've heard this described like taking connecting flights. Like, if I can't fly direct from New York to some tiny regional airport in Thailand, I have to hop through London, then Bangkok, and then maybe drive.
That's the standard analogy, yeah. But let's look at the actual financial reality of that layover. In the airline world, a layover really just costs you time.
And maybe your patience.
True.
Yeah.
But in banking, every layover, meaning every intermediary bank in that chain traps capital. Bank A has to keep a massive pile of money sitting in Bank B's accounts just to facilitate these potential transfers.
This is the trapped liquidity concept I was reading about in that thesis from Jönköping University.
Precisely. They are called Nostro and Vostro accounts. We are talking about literally trillions of dollars globally that are just sitting dormant. They are pre-funded in foreign accounts, doing absolutely nothing productive.
Just waiting there in case a transfer needs to happen.
Exactly. It is incredibly expensive capital inefficiency.
And ultimately, I'm the one paying for that inefficiency. The Jönköping thesis actually mentions that in late 2024, the global average cost to send $200 was still over 6.6%.
And if you used a traditional bank transfer, it was even worse, averaging over 13%.
That's just wild.
But that is the literal cost of the friction. The bank isn't just charging you for the digital wire. They are charging you to maintain the liquidity required to make that wire possible in the first place.
Okay, that explains why it's so expensive. But what about the speed? Why 3 to 5 days to clear?
Because those messages we just talked about, they are sequential. Bank A messages Bank B. Then Bank B has to verify it, check compliance, debit the account, credit the account, and then message Bank C.
So if there's a hiccup anywhere,
The whole chain stops. If there's a typo or a compliance flag at Bank B, everything halts. It's heavy manual intervention in what should be a digital world.
okay, so that's the dinosaur. Enter the meteor, Ripple. Because for years, the crypto crowd has been shouting that Ripple and its token, XRP, were going to just burn the banks to the ground.
That was the rallying cry, yeah.
But let's look at the actual mechanics of how they solve this layover problem we just talked about.
So Ripple's approach, specifically what they call on-demand liquidity, or ODL, is genuinely clever because it basically deletes the need for those pre-funded dormant accounts.
But how does the money actually move if there's no cash sitting in the middle waiting for it?
It uses the digital asset XRP as a bridge currency. Let's trace a transaction. Say you want to send US dollars to euros.
Okay.
In a split second, your dollars are converted to XRP on a digital exchange. That XRP then travels across the XRP ledger to a destination exchange in Europe.
And that journey takes what?
About 3 to 5 seconds.
Well-
And transaction throughput is massive, around 1,500 transactions per second. Once it arrives, it is instantly sold for euros, and those euros land right in the recipient's account.
Okay, hold on, though. I have to play devil's advocate here for a second. I know the crypto market is famously volatile. If I'm a big bank and I'm moving, say, $10 million, I can't risk XRP crashing in value during those 3 seconds. That could be a huge loss.
You're absolutely right, and that was the #1 objection from chief financial officers for years.
Yeah.
But here's the crucial nuance. The bank doesn't actually hold the XRP. They don't take on that volatility risk.
So who does take the risk?
Market makers, arbitrageurs who operate on the ledger. They are the ones providing the liquidity and betting on the spreads. The bank is just initiating the transfer. By the time the volatility could even register on a chart, the transaction is completely settled.
The exposure time is just nearly zero.
Exactly.
So the bank gets the speed 3 seconds versus 3 days, and the cost savings without actually having to hold a volatile crypto asset on their balance sheet.
That is the pitch. And the data from the academic research completely backs it up. The thesis suggests Ripple can cut payment operation costs by up to 48%, and total transaction costs drop by 33 to 42%.
That's a massive margin improvement. And there's an environmental angle too, right?
Very much so. Unlike Bitcoin, which uses incredibly energy-intensive mining, XRP uses a proof-of-authority consensus model.
Meaning trusted validators instead of massive server farms computing math problems.
Correct. It's energy efficient. Green enough that even strictly ESG-focused European banks can use it without getting yelled at by their shareholders or regulators.
So on paper, this just looks like a slam dunk. Better tech, cheaper, faster, greener. But for the first half of the 2020s, Ripple wasn't exactly winning. They were practically drowning in legal fees.
Well, you can't rewire the global economy if the U.S. Securities and Exchange Commission is actively trying to shut you down.
The SEC lawsuit. It feels like ancient history now, but man, that cloud hung over everything they did.
It was the definitive bottleneck for institutional adoption. But August 7th, 2025 changed absolutely everything.
That's when the SEC and Ripple filed the joint dismissal of appeals.
Right. It's basically government blinking. Strategic retreat by the SEC.
But we need to be really specific for the listener about what the law actually decided here because it's incredibly nuanced. And to be clear, we aren't taking sides on the politics of crypto regulation here, just reporting the legal outcome.
Absolutely. The core of it comes down to Judge Torres' ruling. She ruled that XRP itself is not a security when it is sold to the public on digital exchanges.
But there was a catch.
There was. She also ruled that when Ripple sold XRP directly to sophisticated institutions like hedge funds or venture capitalists, those specific transactions were securities.
Why the distinction between the two?
It comes down to something called the Howey test. The court decided that sophisticated institutions were buying XRP directly from Ripple with the very specific expectation that Ripple's corporate efforts would drive up the price.
Making it an investment contract.
Exactly. But an everyday person buying it blind on an exchange, the court said they're basically just buying a commodity.
So Ripple ended up paying a fine for the institutional sales. I think it was around $125 million. But the technology itself, the token, was ruled legally clear to use.
Yes. And that distinction is everything, because it gave general counsels at major U.S. banks the psychological permission to finally say yes. Before August 2025, using Ripple was a massive compliance risk. After that date, it was just a business decision.
And it wasn't just the courts moving the needle, right? Congress finally started doing something in 2025 with the Genius Act.
Oh, the Genius Act. It stands for Guidance for Emerging New Integrated U.S. Stablecoins Act.
A truly terrible acronym.
Typical Washington, but a very crucial piece of legislation. It moved through the Senate in mid-2025 and finally set actual reserve requirements for stablecoins in the U.S.
Meaning if you issue a digital dollar, you have to actually have a real dollar sitting in a vault to back it up.
Which seems painfully obvious, but it wasn't strictly U.S. law until then, and the U.S. was really playing catch-up globally.
Because the rest of the world wasn't waiting for the SEC to make up its mind.
Not at all. The European Union already had the MiCA regulation fully online, providing very clear rules. Ripple was already expanding heavily through a hub in Luxembourg. The UAE was light years ahead. The SEC realized that if they kept fighting in court, the future of finance would just pack up and move to Dubai or London.
So the regulatory shackles finally come off, and looking at the market research charts from Digital Asset Solutions for the third quarter of 2025, the market reacted in a way I honestly didn't expect.
The divergence in the data.
Yeah. Transaction volume on the XRP ledger just exploded. It was up something like 500%. But the number of new retail user addresses actually dropped, which seems backwards. Usually you want user growth.
Normally, yes. But in this specific context, that divergence is the single most important signal in the data. You don't just want user growth, you want utility growth.
Okay, unpack that.
The drop in retail users means the hype cycle ended. The speculators, the day traders hoping to get rich quick, they left the building. But that 500% increase in volume, that means the whales finally arrived.
The institution.
Yes. We are talking about major payment processors and banks finally running actual heavy transaction volume through the crypto pipes.
So the plumbing finally started acting like actual plumbing rather than a casino?
Exactly. And Ripple shifted their corporate strategy to match that reality. That's why they launched ROUSD Real USD, their own stablecoin.
See, I've found that confusing at first. If they already have XRP, why do they suddenly need a stablecoin?
Because banks fundamentally love boring things. XRP is fantastic as a bridge for speed, but for absolute settlement assurance, banks still prefer a tokenized US dollar.
Because it removes even that tiny fraction of a second of volatility risk.
Right. It reduces friction even further. Ripple basically looked at the market and said, fine, if you don't want to touch the volatile asset at all, here's a perfectly compliant digital dollar that works on our exact same fast rails.
They bought a prime broker too, didn't they?
Hidden Road, yes. They acquired them to control more of the actual institutional infrastructure.
Wow. And there was one more piece of the puzzle that fell into place last year that really set the stage for where we are now: the Federal Reserve and the ISO 2022 standard.
This is the nerdy part of the research, but it actually matters the most.
Yeah.
ISO 2022 is a global data messaging standard.
So you mentioned the old telex system earlier. Is this the modern upgrade?
Sort of. Think of the old legacy Swift messages like an SMS text message. You get 160 characters, very limited info, basically just pay $50.
Not a lot of context.
Right. ISO 2022, on the other hand, is like an email with rich attachments. You can embed invoices, heavy compliance data, tax information, origin details, all right into the payment message itself.
So the crucial data travels with the money rather than separately.
Correct. And in July 2025, the U.S. Fedwire system officially adopted this standard. Now, Ripple was already natively compliant with ISO 2022.
I see where this is going.
Suddenly, plugging Ripple software into the U.S. Federal Reserve System wasn't some massive translation nightmare anymore. It was essentially plug and play.
Okay, so let's pause and look at the board. Ripple has survived the SEC legal battle. Institutional volume is skyrocketing. They have a compliant stablecoin, and the Fed is literally speaking their language.
They were holding all the cards.
You'd think this is the part of the story where Swift just curls up and dies, right? Like Blockbuster Video when Netflix started streaming.
You really would think that. But Swift didn't die. In fact, late in 2025, they pulled a move that I honestly didn't think a 50-year-old consortium had in them.
The Empire Strikes Back.
Big time. At CBOS in Frankfurt, which is essentially the Super Bowl for global bankers, Swift CEO Javier Pérez-Tasso dropped an absolute bombshell. Swift wasn't just quietly upgrading their messaging standards. They announced they were adding a blockchain-based shared ledger to their own infrastructure.
Wait. The centralized, slow dinosaur of banking built a blockchain.
They did. But they built it very differently than the crypto purists would. They piloted it with over 30 of the biggest banks in the world. Citi, Chase, Deutsche Bank, Wells Fargo.
Just the absolute heavyweights.
Right. And the goal was real-time, 247 cross-border payments moving tokenized value on a single source of truth ledger.
But is this actually real tech? Or is this just a marketing sticker, like putting a turbo badge on a minivan to make it sound fast?
No, this is legitimate, deep tech integration. And the key to it all is smart contracts. Remember how we said compliance checks were the main bottleneck slowing everything down?
Yeah, the manual reviews stopping the chain.
Swift is now using smart contracts to completely automate that compliance layer. Before a transaction even initiates, the smart contract checks the sender and receiver against global sanctions lists. It verifies the funds are actually there, and it locks in the fees.
So it pre-validates everything.
Exactly. If any single check fails, the transaction simply never launches. That trapped liquidity problem we talked about, where money gets stuck in limbo for days, the smart contract mathematically prevents it from happening.
Okay, so they essentially fix their own friction. But here is my biggest question then. If Swift now has a blockchain, and Ripple has a blockchain, aren't they just doing the exact same thing now?
Technically speaking, the technology is definitely converging, but Swift's core strategy here is interoperability. They aren't trying to force everyone onto their specific chain. They know the future is highly fragmented.
Meaning lots of different networks.
Right. You're going to have a private JP Morgan chain. You'll have public chains like Ethereum. You'll have central bank digital currencies in places like China.
And Swift just wants to be the universal adapter that connects all of them.
Exactly. They're positioning themselves as the chain of chains. Think about it from the perspective of a bank executive. Do you want to build expensive, custom integrations for 50 different emerging blockchains? Or do you want to just plug into Swift, which you already use and trust, and let them route the value seamlessly wherever it needs to go?
That is an incredibly compelling argument for a risk-averse banker. It's like the old saying, nobody ever got fired for buying IBM. In this case, nobody ever got fired for using Swift.
Trust is their ultimate mode. Ripple might have had the better pure technology in a vacuum 5 years ago, but Swift has 50 years of entrenched infrastructure and handshake agreements with central banks.
So where does this actually leave us now? It's early 2026. Is this a war, or is this basically a marriage?
It looks a whole lot like convergence. You have Ripple becoming significantly more centralized, right? Working hand in hand with regulators, launching stablecoins, acquiring brokers. They're acting very bank-like.
And on the flip side, you have Swift adopting distributed ledgers, utilizing smart contracts, moving tokenized assets. They are acting very crypto-like.
Precisely. It actually reminds me of a great quote from Ripple's leadership in an interview with Global Trade Review recently. They explicitly stated, "We are not replacing Swift."
Wow, quite a change in tune from the early crypto days.
It's just the reality of the market. It's not a zero-sum game anymore. They position themselves as a complement. Ripple is carving out a massive, highly profitable niche in what we call exotic corridors.
Like sending money from Brazil to the Philippines or Mexico to Thailand.
Exactly. Places where Swift's traditional correspondent banking is just too slow and vastly too expensive.
But Swift gets to keep the heavy iron highways, the massive volume moving between the US dollar and the euro.
Likely, yes, at least for the foreseeable future. They are fighting for the same technical ground now, but they are serving slightly different core needs.
I have to wonder, though, what about the crypto purists? You know, the people who bought Bitcoin back in 2011 specifically to destroy the traditional banks? Watching Ripple and Swift basically become two sides of the exact same coin must be absolutely heartbreaking for them.
Oh, they despise it. The hardcore crypto community heavily criticizes Ripple for being too centralized because Ripple Labs still holds vast amounts of XRP. And Swift's ledger is obviously permissioned and centralized by design.
A betrayal of decentralization.
That's what they call it. But here is the hard truth about the global economy. Pure decentralization was never actually the goal for institutions. Efficiency was the goal.
Right. A major bank doesn't want censorship resistance. They absolutely want to know exactly who they are sending $1 billion to.
They demand a permissioned world. They do not want some random anonymous miner in a basement halfway across the world validating their massive corporate settlements. They want a known, legally accountable entity. For Wall Street, centralization is a feature, not a bug.
So let's bring this all the way back to me, just trying to send a few bucks to a freelancer in Tokyo. What does all this massive convergence actually mean for the listeners sitting at home?
It means the invisible walls of global finance are finally coming down. Whether your local bank uses Ripple's ODL in the background to route your payment, or they use Swift's new interoperable smart ledger, The end result for you is exactly the same.
That ridiculous 13% fee I paid.
That's going to collapse to near zero over the next few years. And that agonizing 3-day wait simply becomes 3 seconds.
So the ultimate winner isn't really Ripple and it isn't really Swift. The winner is the customer.
The customer and the broader global economy. Think about it. If we unlock those trillions of dollars in trapped liquidity capital that is currently just sitting in foreign accounts doing absolutely nothing, that is a massive injection of capital efficiency into the world.
It means faster global trade, cheaper remittances for families sending money home, just better economic growth overall.
Exactly.
It's funny, we started this deep dive looking for a massive showdown between the old guard and the shiny new challenger. But what we actually found was something much more interesting. Evolution. I mean, the internet didn't kill the phone companies. The phone companies just adapted and became internet service providers. And now the traditional banking system is just absorbing the blockchain upgrade.
And I think that leads to the absolute biggest question of all for anyone following this space. If Swift successfully adopts the exact technology that was supposed to replace it, and Ripple becomes a foundational pillar of the established banking system.
Does crypto even exist as a separate industry anymore?
I really don't think it does. I think by 2030, nobody's going to say, I'm making a crypto payment. They'll just say, I'm making a payment.
Yeah.
The crypto part will just be the invisible plumbing, exactly like TCP/IP is for the internet today. You don't think about it, it just works.
Invisible plumbing. I really like that. Honestly, it's something for you to mull over as you watch these markets evolve. But as long as my money gets to Tokyo before my coffee gets cold, I really don't care what you call it.
Amen to that.
Well, that's it for this deep dive into the future of money. Thanks for exploring it with us, and we'll catch you on the next one.